I step out into the street. Wind hits my face. Cars hum past. I ask 10 people. Heard of tokenization? Blank stares. One nods hesitantly, probably gazing. Then I try again. XRP, HAR. Any of this sound familiar? Silence. Most people aren't clueless because they're lazy. They're clueless because the system is shifting under their feet, and nobody hand them a map. Right now, digital rails are being laid, quietly. Stocks, bonds, real estate, commodities, even identities and financial contracts. Ownership itself is being redefined. And here's the thing, transitions like this never arrive with a neon sign. They look technical, boring. They look like bankers' homework. Until one day, bam, the new system is live, and people who understood it early are operating in a financial world everyone else still thinks is normal. So let's start with the obvious. If you think tokenization is just crypto, stop. It's bigger, it's structural. And today I'll show you how it works, why institutions are preparing, why crises accelerate adoption, and why early understanding could separate winners from the crowd. Markets don't fear bad news. They fear what most people haven't noticed yet, and that's exactly what we're about to explore. Over the past week, several financial markets recorded notable shifts. Equity indices in the US moved unevenly. The S&P 500 rose 1.8%. The Nasdaq gained 2.3%, while the Dow Jones held mostly flat, up 0.2%. Volatility measures, as represented by the VIX, decreased slightly from 18.7 to 17.9. Trading volumes on major exchanges were consistent with seasonal averages, around 7.5 billion shares traded per day across US equities. In the bond market, Treasury yields climbed. The 10-year note yield moved from 3.78% to 3.86% over 4 trading sessions, marking the fastest short-term uptick since early February. Corporate spreads on investment-grade bonds remained relatively steady, while high-yield spreads widened by 5 basis points, signaling slightly increased risk perception among lower-rated issuers. Commodities exhibited mixed behavior. Gold prices edged up from $1,992 to $2,012 per ounce, while oil experienced more pronounced movement. WTI crude rose from $81.40 to $84.20 per barrel within 3 trading days. Cryptocurrency markets, including Bitcoin and Ethereum, showed modest recovery after a 2-week pullback, with Bitcoin moving from $27,300 to $29,100 and Ethereum from $1,850 to $1,940. XRP rose 6% during the same period, though overall market capitalization remained below prior all-time peaks. Globally, foreign exchange markets saw the US dollar index, DXY, stabilize around 104.1 after a brief spike to 104.8 midweek. Volatility in major emerging market currencies remained elevated relative to the US dollar, reflecting continued macroeconomic uncertainty abroad. Settlement and trading data from large digital asset platforms confirm faster transaction times for tokenized assets. Trades that previously required T+2 or T+3 days for settlement now execute within seconds on certain digital ledgers, reflecting the operational impact of tokenization infrastructure, particularly for large-cap digital assets. Compared to last month, these shifts suggest capital is redistributing across asset classes with different liquidity and risk profiles. However, no regulatory or macroeconomic event fully explains the pattern. It appears driven by market microstructure and ongoing adjustments in institutional positioning. All figures above are sourced from publicly available exchange data, Bloomberg terminals, and official market feeds. They represent confirmed observations as of the last trading week. When equities rise unevenly and bond yields climb, it's not just a chart moving, it's capital flowing, risk repricing, and incentives shifting. The Nasdaq's 2.3% gain tells us technology and growth assets are attracting liquidity faster than industrials or legacy sectors. That in turn can influence how asset managers allocate capital, where hedge funds target hedges, and which sectors see new inflows. Rising treasury yields are more than numbers. They affect borrowing costs across the economy. A 0.08% move in the 10-year yield can subtly increase mortgage rates, corporate loan costs, and financing for governments issuing new debt. Investors react. bonds become slightly more attractive versus equities, which can slow equity inflows and push some capital into fixed income markets, particularly short-term instruments. Commodities moving in opposite directions adds another layer. Oil's jump signals increased industrial demand expectations or geopolitical concerns affecting supply. Gold's modest rise reflects a flight toward liquidity and preservation of purchasing power. The divergence matters because portfolio managers must balance inflation hedges, energy exposure, and safe haven positions simultaneously. Digital assets, especially tokenized assets like XRP, aren't just volatile tickers. They represent a shift in settlement efficiency and ownership mobility. Trades completing in seconds rather than days mean capital can rotate faster. Risk can be managed more dynamically, and institutional desks can execute strategies previously constrained by legacy settlement systems. For example, if a large-cap tokenized stock can be reallocated instantly, that may reduce friction in hedging or arbitrage operations. The foreign exchange stabilization tells another story. The DXY holding around 104.1 implies that, while global markets are adjusting, the US dollar remains a central anchor. Emerging market volatility suggests capital is still cautious and movements there can cascade into cross-border investments, debt servicing, and corporate cash management decisions. Taken together, these shifts are subtle signals of a broader mechanism. When settlement speeds improve and markets redistribute capital across sectors, institutions can respond faster to risk, exploit inefficiencies, and reposition portfolios before retail participants fully recognize the change. Early reactions in equities, bonds, commodities, and tokenized assets can trigger chain reactions in liquidity, price discovery, and sector rotations. The first-order effect: faster capital allocation and rebalancing. Second-order effect: potential structural shifts in how assets are held, hedged, and migrated across the financial system. Who feels it first? Institutional desks, large asset managers, and sophisticated traders who can act on milliseconds of settlement advantage. In short, what may appear like ordinary market movement is actually a window into evolving market mechanics, an environment where speed, mobility, and settlement efficiency are beginning to define who can respond and who lags behind. Financial systems rarely change quietly. Look back at 1944, the Bretton Woods Conference. Global finance was fractured after World War II. Currencies were unstable, capital flows fragmented, and trust in institutions was fragile. The solution? A new system built on clear rules, coordinated central banks, and standardized settlements. It didn't happen overnight. It was a response to pressure, not idle curiosity. Fast forward to 2008, Lehman Brothers collapses. Overnight, confidence erodes. Regulators step in. Liquidity dries up. Capital that moves smoothly one day stalls the next. Banks scramble to re-establish trust and new frameworks. Stress testing, Basel III, quantitative easing emerge. These weren't optional innovations. They were structural adjustments to a system under extreme stress. Even 2020 tells a similar story. Pandemic-induced lockdowns caused liquidity shocks. Central banks injected trillions. Markets adapted to remote operations, digital settlement systems, and automated trading environments. Tools that were experimental before suddenly became operational necessities. What's consistent across these examples? Crises catalyze change. Calm periods rarely trigger major infrastructure shifts. And when they do, the first movers gain a disproportionate advantage because they understand the new rails before the public catches on. What's different this time? The change is technology-driven, not purely regulatory or crisis-driven. Tokenization, programmable settlement, and digital assets allow capital to move instantly across borders and asset classes. The scale is global from day one, touching equities, bonds, real estate, and commodities simultaneously. Historical precedents involve the gradual steps, post-war reconstruction, incremental banking reforms. Today, the system itself is programmable. Transactions that once required days now settle in seconds. History then is a lens. It doesn't tell us what will happen next, but it does highlight patterns. When infrastructure is stressed or inefficient, new solutions emerge. Those solutions gain traction fastest among participants who act before clarity is obvious. The same principle applies to today's digital rails and tokenized assets. Early adopters are not just experimenting. they're positioning to operate on the next generation of financial infrastructure, while others remain on yesterday's system. If tokenization and digital settlement infrastructure continue to roll out smoothly and institutional adoption gains momentum, then capital could migrate rapidly toward these new rails. Early evidence shows trades that previously required days now settle in seconds. If regulatory frameworks align, interoperability between digital assets, equities, and bonds improves, and liquidity remains sufficient, then the system could handle trillions more efficiently. In that scenario, first movers in tokenized assets, digital settlement platforms, or related infrastructure could see structural advantages. Market efficiency will improve, spreads could tighten, and volatility may decline as execution friction diminishes. Base case, gradual integration. If adoption occurs unevenly across sectors and geographies, then progress will be steady but not dramatic. Traditional equities and bonds continue to coexist alongside tokenized alternatives. Trades still settle slowly in some segments while others move instantly. In this scenario, liquidity will rotate gradually, with pockets of fast-moving capital in tokenized assets and slower flows elsewhere. Price signals will remain somewhat noisy as the system adapts. Market participants who understand the direction of infrastructure can reposition over time, but the broader public will experience incremental rather than revolutionary shifts. Efficiency gains occur slowly, reducing systemic stress without triggering abrupt reallocations. Bear case, friction, and regulatory headwinds. If regulators impose restrictive frameworks, interoperability fails, or settlement platforms experience operational failures, then adoption could stall. Capital might hesitate to migrate, and tokenized assets could experience sudden liquidity shocks. In this scenario, volatility could spike across correlated markets. Equities, bonds, and digital assets could react to stress in settlement channels rather than fundamentals. Early adopters may face unexpected operational or compliance risks, while institutional capital hesitates to redeploy efficiently. The bear case doesn't imply failure of tokenization as a concept, but it would mean a slower transition and temporary disruption, with first-mover advantages muted until infrastructure reliability improves. Across all scenarios, a few consistent observations emerge. Settlement speed and efficiency are central levers. The faster the rails, the more capital will gravitate there. Regulatory clarity, or lack thereof, directly affects adoption pace. Institutional behavior sets the tone. They operate at scale, not short-term snapshots. Market participants who understand the infrastructure's trajectory will have a planning advantage regardless of immediate price action. Each scenario depends on conditional variables, adoption speed, regulatory guidance, operational reliability, and macroeconomic context. None are certain, but viewing the system probabilistically allows participants to position thoughtfully, layer risk, and prepare for structural shifts rather than reacting emotionally to headline-driven volatility. First, the US dollar index, DXY. A stable or strengthening DXY signals that global capital is still anchored to the dollar. Sudden dips or spikes can shift cross-border flows, affecting emerging market currencies, treasury yields, and even commodity pricing. Watching the DXY gives early insight into where liquidity prefers to sit. Next, treasury yields, particularly the 2-year and 10-year notes. The yield curve's shape tells a story about risk, sentiment, expectations of rate changes, and capital allocation. If short-term yields rise faster than long-term yields, markets may anticipate tightening or short-term stress. Conversely, flattening or inverted curves can signal risk aversion or migration of capital toward perceived safety. Inflation metrics, CPI and PCE, remain central. Faster than expected inflation can pressure central banks to tighten policy, indirectly influencing liquidity and asset rotation. Tokenized assets and digital settlement networks may react differently than traditional markets because they allow faster capital repositioning. On the digital side, volume and transaction speed on tokenized assets matters. Metrics like daily settled value, latency of trades, and adoption rates for digital custody platforms show whether the infrastructure is operational at scale. If trades consistently settle instantly without friction, the system is transitioning from experimental to functional. Finally, open interest and positioning in both derivatives and tokenized markets revealed where large players place their bets. Rising open interest in tokenized ETFs, synthetic assets, or derivatives tied to digital infrastructure can hint at institutional confidence in the system's trajectory. Watching these indicators together provides a composite view. DXY tells you about global liquidity anchors. Treasury yields and inflation show systemic pressure points. Tokenized transaction metrics reveal whether new rails are moving capital effectively. And open interest shows who's acting on the infrastructure. The key: this isn't about reacting to social media chatter or headline-driven momentum. It's about seeing the operational mechanics, the flows, settlements, and positioning that determine how the financial system is evolving. That's where actionable insight comes from. Markets are shifting, but the shift isn't random. Ownership is becoming digital. Settlement is moving from days to seconds. Infrastructure is quietly evolving, and the first movers are positioning while others are still figuring out what tokenization even means. This isn't about chasing the next shiny asset. It's about understanding how the system itself operates and how that changes the rules of capital allocation. Watching the right indicators, recognizing structural advantages, and preparing for slower or faster adoption are the steps that matter. The key takeaway: opportunities aren't mysterious, they're structural. Those who study, understand, and position themselves early gain an edge. Those who wait for headlines may miss the phase where the system rewards foresight. This isn't investment advice, it's simply how I'm reading the market right now. Risk management, patience, and long-term thinking remain essential.